And our last speaker of the day is Ryan Selkis. He's the CEO of Messari, who will talk to us about self-regulating across borders. Ryan?
All right, so I'm going to wait for a clicker. Here we go. Thank you very much. I know that I'm the only person standing between everybody in this room and cocktail hour, so I promised Perry Ann I'd keep it to 10 minutes. I will keep it to 10 minutes. For those that don't know me, my name is Ryan Selkis. I'm the founder and CEO of a new company called Messari. Used to run CoinDesk. So I've been around information and data in this industry for a while. And what we're doing at Messari is creating an open, standardized, accessible, free data library to serve as the Edgar of sorts for the crypto asset industry. Naturally, I'm a contrarian. So you've heard a lot of optimistic presentations and terrific upbeat speakers over the course of the last couple of days. I'm going to talk about everything that's wrong with the industry to wrap things up, or at least my impression of what's wrong with the industry. And it's pretty straightforward, and I wouldn't say that it's easy, but it's at least straightforward what some of the solutions are. And a lot of it comes down to information asymmetries and just poor data standards across the industry. So if you think about the frothiness of the markets right now, I think about the lack of transparency, the lack of fundamentals, and just the lack of structured data and apples-to-apples comparisons that people can make that's really holding back this industry before it can get to an institutional investor base. Everybody's favorite drinking partner, Jake Layton. Let's start with him. So I think top of everybody's mind in the last couple of months has been the SEC's comments on these ICOs, and specifically that they pretty much all have the hallmarks of a security. And it kind of makes sense, right? You've got funds very often investing at discounts into tokens that don't necessarily trade but are expected to increase in value. You've got founders that have tokens that are vesting according to some schedule. You've got even structured sales of secondary sales and management of treasuries. These things look a lot like securities, but I think most people in this room would argue that tokens are not necessarily securities. I certainly would. I know that the chamber is doing good work there, and most in the industry are very rightfully scared of how the SEC could curb some of the innovation in the industry if they were to indiscriminately crack down. Now, the good news is, I don't think that's going to happen. Because if you look back at Chairman Clayton's comments in November, he very clearly laid out paths to self-regulate via transparency. And in particular, he talked about sunlight being a disinfectant. He talked about other precedents for self-regulatory organizations being successful at reining in excesses and punishing bad actors within certain communities. And he flat out said, are there opportunities to deter, mitigate, or eliminate wrongdoing before we have to pursue enforcement? And I think you're starting to see some of that percolate and get taken very seriously by most of the major players in the industry. The second thing I think that better data will solve is answering the what happens next question. We're in a bull market right now. Everybody's a genius in a bull market, right? But when the music stops and we have a correction, we've had this boom bust cycle several times already in Bitcoin and now kind of in the broader ICO market, you're starting to see the bull cycle. What happens next, right? What happens in the transition to fundamentals when the Amazon of crypto corrects by 80%? And we want to make sure that we have some way of ascribing fundamental value to some of these assets so that the entire asset class doesn't get taken out by the euphoria of the market and it doesn't get a bad rap in the investment community just because things got a little bit overheated to start. And some might argue that that's actually a good thing if the tide goes out. But what happens next? And then finally, more tactically, how do we solve this data standardization issue across this wide range of industry actors that are all trying to pull the same low-level, low-value information about crypto assets? You've got media and research companies on the one hand, you've got advisory groups on the other. I mean, you've got even data services providers that are trying to get very remedial bits of information, like what's the liquid token supply in a market? How much of a token supply is unlocked versus encumbered because an investor's stake vests over a 3-year period or a founder's stake invests over a 4-year period? These things are remedial type of information and data points in the public equities markets. I think a lot of people are doing the work to aggregate this information today. The issue is there's no low-level database that includes all of this, right? I swear there's 30 different projects that I've spoken with where the entrepreneur's one-line pitch is, we're going to build the Bloomberg of crypto. Well, good for you. Good luck. You can't do that until there's an Edgar because there's no data standardization at the base layer. There's no way that you can even have a reliable low-level data source in order to build all the tools that would be more relevant for institutional investors. That's where we come in at Messari. We're building this open source, free data library that we hope will serve as the base layer for data and information in this industry. And that sounds simple enough, right? But if you think about getting global consensus on anything in this market, it's a lot more difficult than meets the eye. So we've actually developed what we call our NOVA principles. Non-controversial, objective, verifiable, actionable information. That's all that we're going for at first. So, we could go out and we could say, we've got this 30-point disclosure document that we want all ICOs to file. And you're going to end up having Filecoin and Blockstack and Civic and maybe some of the higher profile, more reputable entrepreneurs. They're going to come back with SEC grade, S1 type of disclosures and prospectuses. But if you look at the long tail, you're going to get crap in. So you're not going to be able to compare project to project. Instead, what we're trying to do is we're trying to just get the very, very basics. Who are the principals? Where is this located? Are they represented by a reputable law firm? What is their website? Where is their token sale information? Very, very simple stuff on the project one-on-one side. And then the other thing that's super important, we have to get liquid supply. This is really where the rubber meets the road, I think, when it comes to the SEC's interests, CFTC, all of the major regulatory bodies, not just in the US, but around the world. It's how are these tokens moving and who's selling them, right? So it's relatively straightforward to get inflation rates for Bitcoin and for Ether and for some of the other high profile assets that are just released algorithmically. But when you talk about these tokens that are released, nobody knows when an insider at a token project that's raised $100 million is going to sell 5-10% of their stake, which might be multiple percentage points of the total money supply. And if you have a dynamic where funds are investing and they're getting discounts, and they don't disclose when they're selling onto Joe Sixpack in the public markets, that's where I think a lot of the issues are going to stem. Can we enforce, or can we create some type of community pressure or mechanism to get the major insiders to disclose not just when they sell, but how? Do they have some type of programmatic selling as they introduce new supply to the market? I think we're off to a good start in terms of solving the community consensus problem. We set out in the beginning of the year to raise money from a global group of investors that would help us apply social pressure and make serious inroads internationally with the regulators. And I'm very pleased to share, I think we've gotten off to a good start. We have 13 of the top crypto funds in the industry invested in our seed round, along with a number of the highest profile angels. And they have relationships that span from China and Korea and the Middle East and Europe and all throughout North America. They are one major stakeholder in the equation when it comes to creating social pressure. The other two being the exchanges and then the advisory groups that are helping to bring some of these projects to market. We've got the first one taken care of. The second two, I hope in the coming months and fully expect, based on some of our early conversations, will be our allies as well in putting together this initial database and almost forming a common app of sorts for token compliance and disclosures. The good news is we can get a lot of this stuff without any support, quite frankly. Some of the low-level data that we're collecting right now, we're talking about creating a Crunchbase almost. You can get 75% of the information just based on what's already publicly available about all these projects. The key is how do you improve upon that, and how do you actually get something that is going to be updated by some decree if you're a token project. So that you're sure as an investor you have access to the same information as the funds that have backed the project. So when we talk about this migration from a Crunchbase, quote unquote, to an Edgar, that's really where we want to get to. And I think if we're successful in the long term, the whole concept of a 10K or a 10Q or an S1, not just in crypto, but more broadly speaking, will be rendered obsolete because we'll be able to report a lot of this in real time. Much more to come. Thank you very much for having me, and thank you to the Chamber for a fantastic event.